Every major city is filled with stores that look abandoned, yet they never disappear. The lights stay on, the signs remain, and the rent is paid, but no customers come inside. These are not failed businesses, they are ghost stores, and they exist because empty retail space has quietly become one of the most profitable financial tools in modern capitalism. Behind dusty windows and locked doors is a $150 billion tax strategy that allows corporations to turn loss into power, emptiness into advantage, and dying storefronts into massive financial gain. What looks like economic collapse is actually a perfectly engineered system designed to extract money from failure itself. Walk through any downtown district and the pattern is impossible to ignore. Entire blocks of retail space sit empty for years. Shopping malls decay in slow motion. Prime real estate stays untouched even as housing shortages grow and small businesses struggle to survive. This isn't just the result of online shopping or economic downturn. Many of these properties belong to massive corporations that could easily reopen, redesign, or repurpose them, yet they deliberately choose not to. Instead, they allow these locations to remain frozen in time, neither alive nor fully dead. The reason lies in a financial paradox. In traditional business logic, losses are bad, but in corporate finance, controlled losses can become extremely valuable. When companies operate physical stores, every expense, depreciation cost, and operational failure can be converted into a tax deduction. The worse a store performs, the more financial leverage it can generate elsewhere. A failing retail outlet in one city can erase profits from another, reducing tax obligations across entire global networks. This transforms empty storefronts into financial shields. Instead of shutting down and selling the space, corporations maintain just enough activity to keep the store classified as operational. This allows them to continue claiming losses year after year, turning stagnation into a long-term financial asset. What appears to be abandonment is actually strategic preservation. The store is no longer meant to serve customers. It exists to serve spreadsheets. Over time, this strategy reshapes entire cities. As landlords hold out for artificially high rents and corporations refuse to reactivate dead locations, retail districts collapse into hollow shells. Small businesses are priced out, new development is blocked. Communities lose access to essential services. Streets become quieter, darker, and economically weaker. Yet behind the scenes, financial reports grow stronger, profits become more protected, and tax bills shrink. This is how modern retail quietly died, not from failure, but from optimization. And this is only the surface, because once you step inside the machinery of commercial real estate accounting, the system becomes far more deliberate, complex, and unsettling. Behind every ghost store is a financial structure designed not for retail, but for tax extraction. Large corporations rarely own their stores directly. Instead, they separate ownership, operations, and leasing into different legal entities. One company owns the property, another leases it, another runs the store, and sometimes several layers of shell companies sit in between. This allows losses to move freely across corporate structures, concentrating profits where taxes are lowest and dumping costs where deductions are highest. When a store underperforms, it becomes more valuable to keep it alive than to shut it down. Rent payments become tax write-offs. Maintenance costs become deductions. Depreciation schedules allow companies to claim that buildings are losing value every year, even when real estate prices are rising. Every broken escalator, every empty shelf, every unsold product becomes part of a carefully engineered financial loss. These losses then travel upward through corporate accounting systems, offsetting profits made elsewhere, sometimes erasing billions of dollars in taxable income. The real magic happens inside depreciation. Commercial buildings are allowed to lose their accounting value year after year, regardless of what happens in the real market. A store that costs $50 million to build can generate millions in paper losses annually, even as the land beneath it becomes more valuable. This creates a paradox where the worse the store performs operationally, the more profitable it becomes financially. Failure, when structured correctly, becomes an asset. Then comes rent manipulation. Many corporations lease property from companies they secretly control. This allows them to set artificially high rents, guaranteeing operational losses at the store level while capturing profits in a property holding entity, often located in low-tax jurisdictions. The store bleeds money. The landlord collects profit. The corporation wins twice, once through tax deductions, and again through controlled internal rent extraction. Over time, these ghost stores become financial anchors, stabilizing massive corporate balance sheets. Instead of volatile sales cycles, companies rely on predictable, controllable losses to smooth profits, manage tax exposure, and protect investor expectations. Retail stops being about selling products. It becomes a financial instrument, engineered to generate tax advantages rather than customers. This is why landlords refuse to lower rents. High rent preserves the illusion of property value, protects loan collateral, and maintains inflated balance sheets. Empty space is preferable to lower prices because collapsing rents would force banks, investors, and pension funds to acknowledge massive asset devaluations. Entire financial ecosystems now depend on pretending these properties are still worth what they once were. So cities remain frozen, storefronts decay, neighborhood economies collapse, but financial system stays intact. What looks like urban decline is actually balance sheet preservation on a national scale. And the deeper you go, the darker it becomes. Because this system doesn't just benefit retailers. It quietly props up banks, hedge funds, private equity firms, and real estate giants whose survival depends on never letting these properties return to real market value. At the top of the system are not retailers. They are banks, private equity firms, hedge funds, and commercial real estate giants. These institutions do not care whether a store sells shoes, electronics, or nothing at all. What they care about is the value of the property, the stability of rental income on paper, and the debt structures built on top of those numbers. Commercial real estate is one of the largest asset classes on earth, worth over $150 trillion globally. In the United States alone, trillions of dollars in loans, bonds, pensions, and investment funds depend on the assumption that shopping centers, malls, and retail buildings are still valuable. If rents fall sharply, property values collapse. If property values collapse, loans default. If loans default, banks take massive losses. If banks take losses, pension funds lose money. If pension funds lose money, retirement systems break. That is the chain reaction everyone is trying to avoid. So instead of letting weak stores die, the system keeps them alive. Not for business reasons, but for financial stability. Zombie stores preserve the illusion that retail property is healthy. Every open door and glowing sign signals to investors that the system is still functioning. Clothing stores would force real price discovery, and real price discovery would reveal how inflated commercial real estate truly is. Private equity firms play a major role here. They buy struggling retail chains using borrowed money, load them with debt, extract fees, sell off assets, and then leave the company barely alive. The stores remain open, barely staffed, poorly stocked, and slowly decaying, but their existence supports massive debt structures and tax strategies. Even when bankruptcy happens, stores often continue operating because liquidation would destroy property values tied to complex loan agreements. Banks benefit because commercial real estate loans remain classified as performing assets as long as rent is technically being paid. Even if that rent is coming from a parent company moving money in circles, the loan stays alive. This allows banks to avoid writing down billions in losses. On paper, everything looks stable. In reality, the system is running on borrowed time. Then there are pension funds. Teachers, firefighters, government workers, and millions of retirees unknowingly own pieces of these ghost malls and dead shopping centers. Their retirement money is invested in real estate funds that require stable property valuations. Letting retail collapse would mean admitting that large parts of these funds are overvalued. That political and social cost is too high, so the system chooses slow decay instead of sudden collapse. This is why entire shopping districts sit half empty for years. Not because nobody sees the problem, but because too many powerful institutions benefit from pretending the problem does not exist. The empty store becomes a financial hostage. Its existence protects massive balance sheets, political stability, and investor confidence. But no illusion lasts forever, and now cracks are forming. The ghost store system is not stable. It only looks stable because money is constantly being pushed into it to stop it from falling apart. But the pressure is building, and now the cracks are becoming impossible to hide. Remote work permanently changed how people shop, commute, and spend. Online retail keeps taking market share. Younger consumers no longer see malls as social spaces. Foot traffic keeps falling, and interest rates, once near zero, have surged. That single shift is devastating for commercial real estate. Most malls and shopping centers were financed with cheap debt. Low interest rates made bad properties look profitable. Now, those loans are resetting at double or triple their original rates. Suddenly, buildings that barely survived before are drowning in interest payments. Property owners are stuck. They cannot raise rents because retailers are already struggling. They cannot sell because buyers know the truth. And they cannot refinance without taking massive losses. So the illusion starts breaking. Across major cities, lenders are quietly seizing properties. Developers are handing malls back to banks rather than trying to save them. Entire retail portfolios are being written down by 40, 50, even 70%. What once looked like premium real estate is being revealed as financial dead weight. And when commercial real estate collapses, it does not fall alone. Banks take losses, pension funds shrink, city tax revenues drop, local governments cut services, jobs disappear, entire communities hollow out. What started as empty stores became economic erosion. This is why the system resisted collapse for so long. Not because ghost stores made sense, but because their death threatens everything above them. Now the delay is ending. The zombie era is slowly closing. And the next phase is transformation. Dead malls are being turned into warehouses, housing, schools, hospitals, and data centers. The physical retail world is shrinking, and a new urban structure is emerging in its place. But this transition will be painful, uneven, and financially violent. Because unwinding a $150 billion illusion does not happen quietly. Every empty store you pass is not a failure of business. It is evidence of a hidden financial system designed to preserve power, protect debt, and delay reality. The lights are still on, the signs still glow, the doors still open, but the economy behind them already moved on. And the longer the illusion lasts, the harder the crash becomes. Next time you walk past a dead store in a crowded mall, ask yourself one question. Is this business alive, or is it just a financial placeholder? If this opens your eyes, like the video, subscribe, and share it with someone who still thinks empty stores are just bad management. Because what you're really seeing is one of the largest hidden financial games in the modern economy.